Hello, everyone, and welcome to today's Osmine webinar series. And today's topic is Beyond Optimisation, Rethinking Resources Value, presented by Scimita Group. I'm Sean Rooney, the Membership Manager for Victoria and Tasmania here at Osmine, and I'm pleased to be your host today. I'd like to acknowledge the traditional custodians of the various lands on which you will work today and the Aboriginal and Torres Strait Islander people attending the event. I'd also pay my respect to their elders past and present and extend that to all leaders of all cultures and backgrounds in our multicultural nation. For today's webinar, I'm joined by Dr. Mobin Nomvar, the founder and managing director of Scimita Group. He has led Scimita's work across the resource, energy and industrial sectors with a strong emphasis on advancing complex technologies from early stage concepts towards commercial readiness. Scimita Group is a deep tech innovation leader focused on bridging research, technology, development and commercial outcomes. Dr. Nomvar is a trusted advisor to deep tech companies and capital. Mobin has led the UN energy initiatives and driven translation of research into real-world impact. He is widely recognised for his ability to connect technical depth with strategic and financial outcomes to improve decision-making and position companies for sustainable success. In the presentation, Dr. Nomvar will explore why the resource to reserve stage is one of the most important and often under-recognised windows for value creation in mining and mineral processing. He will be joined by his colleagues Rick Gross, the Chair of Scimita Group, and Neville Plint, the CEO of Mining Free and Executive Manager of the Critical Minerals for Critical Industries, CRC, both with almost 70 years of experience and leadership of technical innovation and development in the resources sector. In the interest of time, I'll let Dr. Nomvar introduce them in more detail than what I've done during the course of the webinar. So in a world of increasingly complex mineralogy and rising demand for critical minerals, the old model of locking in a flow sheet early and optimising around it has reached its limits. This webinar explores why the resource to reserve stage is one of the most important and under-recognised windows. Let's not underestimate the challenges in value creation and the adoption of innovation and new technology in general in the mining sector. So following Dr. Nomvar's presentation, there'll be an opportunity for audience Q&A. You can use the Q&A button at the bottom of the screen to send through your questions at any time. You can also upvote on other audience questions and the ones you most want answered. So without any further ado, I'd like to now hand over to Mobin to begin the presentation. Welcome, Mobin.
Thank you, and thank you to Osmine for hosting this discussion. The idea I want to introduce today is simple, but I think it has significant implications for the way the mining industry develops complex projects. Mining is entering a very different environment from the one many of our traditional development pathways were designed around. Ore grades are declining, mineralogy is becoming more complex, critical minerals are creating new processing challenges, and many projects can no longer rely on incremental optimization alone. In these projects, the flowsheet is not merely an engineering output. The flowsheet itself becomes part of the innovation challenge. One of the most important places this shows up is the resource to reserve stage. This is where the project value is often shaped. This is the point where assumptions being hardened and product pathways are selected, flowsheet starts to become preferred, test programs are defined, and the study process begins shaping the future economics of the projects. This is the place where small decisions that are made at this stage have a very large impact on recovery, energy intensity, capital intensity, and ultimately reserve conversion. At Scimita, we described this earlier period as the resource innovation window. It is the short strategic window before reserve pathways solidify, when integrated optimization is still possible. It is the moment to systematically challenge alternative flowsheets, product pathways, byproducts, hybrid technologies, energy choices, and many more assumptions before the project becomes locked into a single development logic. Traditional study pathways are designed to reduce uncertainty, and that is entirely rational. Known technologies improve confidence. Simpler flow sheets improve bankability. Standard supply chains reduce perceived execution risks. For many tier 1 deposits and simpler projects, that logic is exactly what should happen. But for complex deposits, where there are multiple pathways to produce multiple products, especially in the context of rare earths, mineral sands, and critical minerals, the same logic can unintentionally constrain value. This is where a deposit can be processed again in multiple ways. Some of those pathways are from chemistry perspective are fundamentally different. Each can produce multiple products, and each one of those products can shape a different future for the deposit. For complex deposits, especially in this context that we are speaking about, we are also shifting from conventional mineral processing into industrial chemistry and chemical engineering. This indicates we need to apply a different thinking to deliver an optimum outcome. Typically, teams rely on familiar pathways. Technical silos, optimization happens at the same time, but in silos. Markets are often considered later. Investment pressure favors proven technologies and solutions. Over time, optionality narrows. By the time their project is deep into PFS or feasibility, many of the most valuable alternatives may no longer be practical to revisit. The question, therefore, changes. The traditional question is, how do we optimize this flow sheet? The more powerful question is, what is the highest value economic future this mineralogy could support? Once we ask that broader question, different opportunities emerge. Alternative products, secondary market, byproduct economics and aggregation of technologies, different recovery strategies, and new commercialization and commercial pathways. This is also why technical readiness alone is insufficient, and commercial readiness needs to be developed in sync. This is where techneconomics is not an outcome. It is a live decision-making tool that guides the way and bonds technical and commercial sides of the projects together. Through the TRL 3 to 7 phase, technical uncertainty, commercial uncertainty, scale-up risk, and capital pressure all collide. If TRL moves ahead of commercial readiness, the project may look technically impressive, but remain commercially fragile and a challenge to attract funds. If commercial pressure pushes the project too quickly towards a scale, critical uncertainties can be left unresolved. The discipline is to align technical readiness, commercial readiness, and investment readiness as the project matures. Hence, there is a need to mature both sides together and systematically, through 3 stages of innovation, mature a project while remaining capital efficient. Proof of science, proof of technology, and proof of engineering. In this way, we have a much higher chance to reach proof of operability stage at full commercial scale. That is the role Scimita has been built to play. We are not arguing for innovation for its own sake. Innovation is not the objective. Value creation is. Innovation is a disciplined mechanism that allows complex opportunities to be explored, governed, de-risked, and converted into commercially viable outcomes. Today, the purpose of this discussion is to bring this idea to life. What does this mean for CRCs and commercialization programs? What does this mean for investors and capital providers? What does it mean for complex resource projects, particularly where rare earth, mineral sands, byproducts, and multiple product markets create both complexity and opportunity? So the key question we must answer is, how do we create governance, partnership, and investment models that preserve optionality while reducing risk?
Thank you very much, Mobin. That's a really interesting and challenging question for the industry. We're lucky today to have Neville Blint, who is representing the critical mineral CRC. And from my perspective, in terms of my history in the industry, one of the real challenges is always how do we create that link between emerging innovation and the ability to be able to bring that innovation into real life projects. So in that context, I got a range of questions that I want to start a conversation. And I've got a range of really interesting questions for Neville in a second, but starting with you, Mobin, for the purpose of our audience, can you put a little bit more color into what you define as the difference between optimizing a flow sheet versus optimizing the economic potential of a resource?
I think it's a very, very, very good question. Also, very important, I guess, implications that shift has. So when you optimize a flow sheet, you're often already locked in terms of chemistry and how it all works from upstream all the way through to downstream of processing steps, right? Also, in the context of a flow sheet that you're optimizing, the products are already being selected, right? So largely, the upside of the project is already being locked in. So all we are doing is we are increasing incremental improvement on operation performance and things like that. When you shift the conversation through how you would increase the economic value of the deposit, now all of a sudden you look at all different products that you can get out of it very early on, the price, payability, scale, and all the specification that impacts the total revenue deposit that can generate. But also before locking in the chemical pathway, right, you've got the opportunity to link that output into the chemistry pathway and a scale of requirements such that you also can improve the capital intensity of the project itself. So it's a very radical change in mindset where you need to navigate effectively through different options, and each one of those options we create different future fundamentally for the deposit.
It's interesting, Marvin, because that needs to happen pretty early in the resource to reserve definition, wasn't it?
That's right. So oftentimes what we see is once scoping a study is almost kind of getting final form and shape. So we know there is something valuable in the deposit itself. It's going to post at a stage. But before you enter the PFS study, within that realm is the optimal place to look at all these alternative options, such that when you do the PFS, you already know what outcome is going to look like.
Yeah.
Right? So PFS is just confirming that outcome.
So Neville, you and I have often had the conversation in relation to that gap that kind of exists, particularly for new novel technologies that is almost entering into that pre-feasibility evaluation. Even if they deliver 20% better MPV, they're perceived to be not too much of a risk to be able to even consider them. It feels to me like what Mobin is talking about is crystallizing an earlier window to make that opportunity viable. What's your thoughts on that, Neville?
Well, first of all, afternoon, and thank you very much for the opportunity to be on the webinar. So thanks very much to Osman and Scimita for the invitation. Just in terms of the question, it's one that is always quite challenging, having been within mining companies and then within research organizations and then technology transfer companies, and sort of just having a look at this problem from multiple different perspectives. And the criticism often sort of leveraged or put in front of the mining companies is that they often criticize for not being innovative enough or not taking enough risk, being risk averse, because they don't introduce these new technologies into their new projects or into the pre-feasibility stage. And when you have a look at it, I suppose they're only really behaving in their best commercial interest, because these technologies, even with a 20% upside, introduce so much risk into a large capital project. And the question is that enough upside for the risk? And often as a technology player, we will emphasize the upside, but often completely underestimate the downside. So what happens if your new technology doesn't work and you've locked it into a new flow sheet, and then you put the entire project, the entire business at risk? So there's this piece around, I suppose, really understanding the customer perspective. And I suppose that's called the commercial readiness part, or the, how is the customer, what is the pathway, what are they going to do? And generally, if you're running a large organization or a mining company, what do you want to do? You want to maximize the value from that project. And to do that, you require a robust, reliable solution. And you need that solution as quickly as possible. So any delay to the project start time really puts your project at risk. And of course, you're looking for the lowest cost, because that's the one thing you can manage. Often prices you can't. So you're really having a look at this, putting a project up, and what you're thinking about is, so what is the risk? What is the time? What are the cost profiles? And then how do we do that? And then, as you rightly pointed out in the presentation, the study process is incredibly well designed to reduce that risk and that uncertainty. And it's designed to reduce that investment risk because nobody wants to make a poor investment. So what this does is it really does limit the opportunities for new technologies, even if they're proven, or even if they're promising but not yet proven. And what will happen is, we see it often, is those technologies get trapped, even though the science could be brilliant. But what they don't have is, they don't have an evidence base that really shows that they're robust. So I suppose the question is, are those technologies robust? Are they reliable over a wide range of real operating parameters? And how do we demonstrate that? So when I was looking through the presentation and chatting with Rick, yourself, and Mobin, is I really do like this concept you've come up with, this resource innovation window. And it's an opportunity where you can pause and say, well, what are those other opportunities? What are the emerging technologies? And let's give them a run through from an economic perspective. So let's have a look at it, and do they offer other opportunities that we maybe haven't considered? And is there some sort of viable commercial opportunities for these, rather than just moving on? And in a couple of projects I've been on, we've had some really courageous project managers who said, well, look, take one of the option studies, because often they're just a variation on the theme. Take one of them and do something really novel with it, and see whether you can get a 20, maybe even a 50% uplift. And that those would then be interesting to take forward. And then once you've done that, I believe one has to be really, really clear as to what is the risk that you need to answer, how you're going to answer it. And that sort of gives you an alignment, where the company, its technology providers, the researchers can all understand exactly what the business driver is. And then based on that, you can solve it and move it forward. And I think that's probably the best chance of getting some of these technologies through that one of those many multiple valleys of death, where we really need to be able to motivate for trying these new technologies.
So Neville, in that context, would you agree that, because what you describe is very much what I've experienced, as you and I have discussed a number of times, but the challenge is even double and triple and quadruple when you start talking about rare earth and critical minerals, because the end product is so highly variable in areas where we're kind of constrained in terms of processing options, because the rest of the world, kind of China, is kind of locking it in, and we don't have too many options. Would that be a fair assumption?
Well, I think where the critical minerals and let's put them all together, the rare earths, but I'm going to say these sort of minor elements that have high value and strategic value, where they become really interesting, is that often you have to extract multiple metals, and you have to have pathways whereby the total project benefits from extracting those multiple metals. And I think where it's the only way you can really compete with a sort of an offtake agreement, where you're competing with existing technology that's got an embedded installation, an embedded flow sheet, is we have to be really creative in thinking about, all right, so how do we extract multiple metals, multiple pay metals, and do that in a really efficient way to compete against those established markets and established technologies. So I think for the critical minerals space, and refining, I'm saying refining in the critical mineral space, this is a great opportunity. This is where you can start to build the optionality into the flow sheet, and you can be responsive then to changing market conditions. So you almost have to move from a single metal, single flow sheet where you lock it in really early and you push efficiencies, to being able to have flexibility and optionality in your project design as you're going along, because the economics are going to be variable, and they're going to be determined by the customer, the end user, more so than maybe with bulk materials, where what they require and the quality specifications will determine what value and what price you can then receive. So Rick, interesting topic, but I think this is where the great opportunity is to really have a look at these flow sheets and not lock them in too early, and make sure you're building options in a very structured way.
Thank you. So Mobin, the opportunity is there from a deep tech innovation house, which is where Scimita operates. What we see in the critical minerals and rare earth space and mineral sands is also a primary and secondary market that gives you lots of options. And so it's interesting that it's not even securing an offtake agreement like Neville suggests. There's almost potentially a step before that to evaluate what that particular mineralogy could actually provide you in terms of primary and secondary markets that are not so transparent. But have you had any experience in that place?
Yeah, I think when you talk about products in that context, there are a bunch of new I guess dimensions open up, because what is going to happen is there's an interesting dilemma in the context of how much of what product needs to be produced and what a specification really means that the customers eventually need for what application, right? That dynamic is very opaque in the market, to the point that in some of the projects that we have been involved in, you really need to the only way that the end user can understand they can use your product or not is actually taking assembly your product, put their own machine, right? And once they do that, they can validate, yep, that's actually got the right specifications for it. And those specification targets are not only purity. There are some morphology, there are some impurity profile, there are a whole bunch of other things that impacts that. Now, when you look at the mineral deposit, it's very interesting in the context of rare earths that are concentrations or in ppm range. We are talking about 600 ppm, 1000 ppm, thereabouts. So the vast majority of the deposit, if you look at it just from a rare earth perspective, doesn't retain value, or this is not being valued, right? So you need to move 1,000 ton of dirt to create 1 ton of product in that context. So this dynamic is exactly the dynamic that understanding it, being in the market, actively negotiating, with the off-takers, but also looking at what future end users are going to be opening up for a certain product that are going to drive the demand for that market in the future. I was actually in a conversation yesterday. We were talking about neodymium as an element. It was nothing. It was not a valuable material the past 20 years, but because of the emergence of permanent magnets, now you're seeing the demand as being increasing, and more of those are being deployed in other applications that are effectively driving the demand. So we need to fundamentally understand what is driving the demand for those, what other applications are going to have an impact on demand increase, and how it all comes into the flowsheet selection, option and study, and ultimately the NPV impact on the deposits.
So it's almost like there are no traditional flow sheets to talk about, because the products are actually emerging.
Is the product also emerging? And there's another dimension that I think is not being spoken about enough in this context. Many of the traditional producers are using already existing flow sheets, but those flow sheets work on a certain economic assumptions.
Yeah.
Right. When you deploy that flow sheet in different economy, they've got different costs for water, energy, different environmental footprint, different labor costs. So that's where the majority of the projects cannot reach viability, right? Which requires a lot of innovation, but that innovation needs to be, as Neville, we argued multiple times, it needs to be evidence driven. So when we talk about TRLs and CRLs, it's not much about confidence. It's about what evidence we need to generate that materially de-risks the technology in the context of the flow sheet and enables the commercialization.
So in that context, I guess the question goes back to the very purpose of the study process, and I think, Neville, is one of the points that I certainly had lots and lots of conversations with emerging startups in the mining industry, that the study process is not meant to block innovation, it's meant to de-risk projects and happens to have a side effect. But the reality in this conversation is how do we attract capital to these new projects that we're talking about? And so in that context, that's the question, Mobin, in the concept that you're introducing. How do you give capital confidence to invest?
I think that's also a very interesting question. Maybe go through proof of science, proof of technology, proof of engineering. It sounds a technical conversation, but in reality, on each one of these phases, not only you require different skills and different innovation appetite, but you're also talking to different source of capital. Like the capital that comes at the proof of science stage is different from the capital that comes at proof of technology and etc. So essentially, the confidence increase in the capital needs to be talked and considered in the context of where the capital is coming from. If you're earlier stages, if you're ASIC listed junior miner, the source of capital is different versus a technology play that you're talking about earlier stage venture capital or otherwise. Once you go to the proof of technology, all of a sudden the source of capital required goes to tens of millions, and if you're in proof of engineering, oftentimes in the hundreds. Right. So, and those guys require fundamentally different depth of the study, a whole different pack of evidence commercially and technically, and a significant, the significance of the test work is not only showing it works, but it needs to demonstrate it works in the context of the commercial opportunity that is being explored, either being a technology provider or the deposit owner.
So, just following from that conversation, I'm going to throw this question at both Neville and Mobin, but I think I'll throw it at Neville first. And you and I were having this conversation the other day, Neville. The biggest issue, one of the biggest challenges with a project when you consider something new, is that if it delays it by a year, whatever the additional payback might be is already gone simply because we've delayed the project, right? And so going back to this innovation window, what we're arguing is that if we think strategically about the potential impact of innovation early enough, we might not be impacting the journey of the project and still have demonstrable proof of technology with offtake agreements because we started early enough. Is that a reasonable assumption, Neville?
So I think maybe just to pick up on the Mobin's last comment and just feed into that one. So what's always interesting is when I've sat with companies and had a look at their and largely it would be your technology companies or companies bringing new tech in or wanting to de-risk the technology, and therefore they do more tests. And the question is, so what is the risk you're trying to reduce, and are the tests you're doing actually reducing the risk, or is this just doing a series of tests to get you to the next milestone or the next funding window? And what I often find is these two things may not be connected, where there isn't a clear understanding of, so what is that fundamental risk? Now, if you're going into a project and, for example, we're doing those studies, and you have something and you know fundamentally that this is really, really useful, but I have uncertainty around this particular aspect, and I'm going to do these 4 or 5 things to answer that question, and it'll take this amount of time to get to that confidence, suddenly that doesn't actually introduce risk or delay into the project. What it does do is it creates that optionality and it creates huge value for the project. So I think it's been very, very clear and crisp in your thinking as to, so what is it that we need to do to make sure that this technology we want to put in is going to be robust and is going to be successful in this project, and bring it along in parallel while you're doing the other studies. So the problem we've got is we use it almost as a go, no-go right up front. I know it doesn't meet these hurdle rates because of this risk, therefore we're not going to look at it. What we will do is we'll continue to look at 4 or 5 other options, which are often just variations on the same technology. We just call them options, but they're not really, because of course that then shows that we've looked at options, but actually we haven't. All we've done is minimize risk because we're sticking with a particular option we're comfortable with. So I think there's some really real opportunity here just to think about the language, think about what we do and why we do it, and create opportunities. And I think uncertainty, if you were an investor, variability, uncertainty is an opportunity. Why don't we see the same thing when we're looking at technologies? So that opportunity is an upside. How do we bring that along? How do we minimize then the uncertainty for that opportunity over that time period? So short answer, Rick, is I think we can do things differently such that we can get these technologies in without delaying the project. So just, sorry, one last thing is the challenge I set the team at Mining 3 and the methane abatement guys was, how do you take a 15-year sort of technology transfer window, that translation of technology, and how do we crunch it into 5? So what are the things that makes it 15? How do we reduce those? How do we do things in parallel? And there are things you can do. So I think we can do this quite differently.
So in that context, Mobin, the innovation window space that you were talking about, if we started that early enough, what sort of timeframes are you think are possible with the sort of experience you have in terms of evaluating options, doing the techno-economics, that would give you ideally potential flow sheets? You then got to do your proof of science and your proof of engineering. That's obviously a big ask, but what sort of timeframes do you think are possible?
So that's another very interesting and important point. Like what you're doing at the moment is, the speed at which you can go through that process fundamentally depends on the tools that you've got available at you, right? So what we do at Scimita is we've got a very strong modeling team, probably one of the best in the country, that can simulate a whole range of different flow sheets very, very rapidly with first principle design and thermodynamics, coupled with targeted test work. Now, that's not enough from our perspective. We took it one step even higher, and we started to integrate AI and generative design into the flow sheeting process. And what we managed to do is we managed to generate, and go through about 1,200 different flow sheet variations within minutes, with full costing, sizing, economics, such that you can actually understand the implications of things like acid strength on recovery, and that has got knock-on effect on crystallization size, and has got knock-on effect on the crusher or otherwise that you got in the flow sheet. But fundamentally, the speed of going through that depends on the tools that you've got available, the team that is behind doing it, and how comfortable they are with the complexities and variations, and also how you're integrating the innovations within the digital world into this phase of study. Just one more thing, I think I'll just pick on what Neville mentioned that was very, very important, I think, from a perspective and experience. When we do downstairs in our piloting facility, when we design a pilot plant, we really look at how big the plant is, right? What we do is we very early on, before even designing anything, right, we need to define what that proof of technology program should look like, right? What technical evidence and should it provide? What commercial evidence it should provide that fundamentally de-risks the technology suitable for that stage. And when you're looking at it from the program design perspective, what you need to have in mind is what that TL9 look like, right? And under what cost structure they should be operating, and bring that forward to the proof of technology program, such that when you're designing a pilot plan, is able to answer the fundamental questions embedded in the proof of technology program, right? So in other words, bigger doesn't mean less risk, right? So if you go big too early, it's actually that's what kills the project, because the iteration costs are becoming impossible, right?
So in that context, Neville, back to you in your leading the new CRC for critical minerals. What's the philosophy of this new CRC in terms of not only driving innovation, but attempting to commercialize innovation? What's the view that you're bringing within that group?
Yeah, so I think when we sort of reached out to interested parties, and it's about 18 months ago, we had a chat with a number of different people across the industry, and there were some very, very clear clear feedback and signals from the partners saying what their expectations was of the CRC. And a really core one was that the CRC, the cooperative research centers, were founded to do research translation. So huge evidence and huge support for the quality of the research that's been done across Australia, across the universities, in the various different research organizations. But really what the focus needed to be was, so how does the cooperative research center enable the translation of the research into commercial outcomes? So right from the beginning, every conversation we've had has been, so what is the pathway to a commercial outcome? How does this program of work or this project, how does it deliver an economic outcome for the country? Because the federal government has very kindly funded the CRC, and they need to get a return on their investments. What is the economic outcome for the participants? So how do we bring different parties together, industry, government, researchers, and how do we all work together to actually create something that one organization couldn't do on its own? And how do we make sure that that is translated into an economic outcome? So I suppose the CRC and the CMCI CRC is going to be very, very focused on that delivery, and we have a whole program that is focusing on commercial outcomes, commercialization, right from the very beginning. And it's probably the very start of the program is to understand, so what is that pathway? And how do we ensure that participants in the CRC derive economic benefit? So that's really what we want to focus on. Our hypothesis is that there is brilliant research that is available. There's really, really good, strong technical teams. I mean, you've heard from Mobin around the modeling skills. There's 4 or 5 organizations that have really got incredible capability, and they've all come into the CRC. We have over 66 participants now, and I think we have commitments coming on with cash and in kind close on 200 million. And it's all people saying we need to work together. We need to have a look at how do we make this happen. And really the CRC's function is just to facilitate. I suppose you could say architect or orchestrate, but the bottom line is how do we get people together and how do we get them sharing such that we can actually deliver an outcome. I mean, we've been very bold in saying that we want to build a refining capability, a sovereign refining capability in Australia. And multiple parties have had a go at this before. And we believe what will be different is the fact that it'll be the partners that come together to do that. So Rick, I suppose we're really pushing hard to be very much like what the original CRCs were put together. And Mining 3 was one of the first CRCs established many, many years ago, one of the first 9. And its focus was very much around how do we do this translation. And I think that's the power and the strength of the cooperative research centers is that commercialization. It is that translation.
So true. I mean, one of the challenges the growth centers were actually facing is the argument that Australia punches well above its weight in terms of the quality of research. You know, the statistics suggest that we produce 6% of the top 1% of research globally, but we don't commercialize anywhere near that much. So, and we you know, with mineral exports being 60-70% of our total exports, we're well placed to do that, but we need to change. And I think that critical minerals and rare earths and are a great opportunity to bring this innovation window. So the next question I sort of throw back to Mobin again, because I think that what you're raising, Neville, is the ecosystem, right? And the question here is that traditionally universities are the ones that create the new heavy research. And what we're putting on the table is that there is a role for a deep tech innovation house that can potentially act as an integration layer. But that's never meant to replace engineering groups, EPCMs, researchers, capitals, or CRCs, right? So the question to you, Mobin, is if we're putting this innovation window into this study phase, how does it interact with the rest of the ecosystem?
I think you know, like nobody has got all the capability requires for every every possible deposit future outcome, right? So I think that orchestrations, you know, this study phase effectively enables the whole ecosystem to dance together, right?
Yeah.
And that's the beauty of it, right? All it does is kind of makes it objective, right? So when we talk about, you know, like even the language of TRLs or technology readiness levels that have been around for 7 decades or more, right? And has been over and over deployed in multiple different industries. The moment that we bring that concept that is very well established into the mining sector, into the study phase, right? That structure automatically gives investor confidence that you're looking for the next inflection point, you're looking for the next risking space. And when you think it from that perspective, it's not about you know, one entity have got all the test equipment that are possible to be had. Like we've got 2 common user facilities that are being kind of conceptualized, one in Queensland, one in WA, you know, and I just had another conversation a couple of days ago with the people in charge for the WA common user facility. It is simply not possible. So what you need to do is you need to be able to have an integration layer, right? That knows and that integration layer has got access to all of those kind of test facilities and experts, you know, that can bring to the study phase and then do using technologies as it goes through those phases. But also equally on the commercial side, though not many organizations have access to market intelligence when you talk about those kind of critical minerals orders. So equally, there is a room for those to come in as well. Another example of that, how it represents is, or was another in another conversation with Mitsubishi resource section of the Mitsubishi, and it's like, why you guys are looking at Australia? And the answer was very interesting. They said, you've got a trading house. The majority of the commodity that goes to our trading house is at the moment is from South Africa. We are looking for alternative markets to provide materials for our trading house so we can trade more. Right? So understanding those and bringing those parties also to the table fundamentally drives these projects. And they're all coming to the study phase.
So thank you, Mobin. So sort of heading back to Neville, we're getting close to the end, but I think there's a really interesting question here, right? I'll put a hypothesis. We do all this work in exploration where we take so much risk, and we get to a point where we finally think we got something interesting, and we take the leap to resource definition, right? And all of a sudden, we kind of go straight down the bottom of the hill. Like we go from resource definition to try to reduce all the risk. And really what we're saying is there's one more short opportunity for this innovation window at that point to open up the boundaries now more in terms of what could we do with that deposit before we start to close it down. And that needs to be leveraged with CRCs, it needs to be leveraged with industry. I guess it seems to me like that's the challenge we're putting to industry now.
Yeah, I think the speed to getting a mine established, as we've said, is key. So what we've got to do is we've got to make sure we move through these stage gates as quickly as possible with as much confidence as possible. But with the critical mineral space, and I think there's an opportunity here and a couple of other deposits as well, just to pause and say, are there opportunities in the minor elements that if we design it in now, adds additional value to the project? And often you'll find that introduces a certain level of extra complexity to your processing flow sheet. And is that worth the complexity? Now, in the past, where operational excellence relies on being very, very structured and stable, you probably don't want to add extra complexity unnecessarily. But have we stopped and asked the question, and have we done the evaluation to do it retrospectively onto an old existing mine and operation is challenging. It's hugely challenging. If you're building something new, now's the time to do it. So yeah, I think it's well worth just taking some time to do it. And with the new modeling capabilities that are out there, one can often do those quick economic assessments really quickly with pretty high confidence, and discard it or move on. So yeah, I suppose what we're advocating for here is is a pause at a particular spot, and I do like the way that Mobin and the team have articulated that, and I think it's well worth looking at, particularly if it opens up other options, and often to add a little bit of capital to unlock that extra value. I mean, that's pretty worthwhile. And in some of the cases we're busy having a look at the moment, which I'll come back and report on in a year or two's time, there might well be opportunity to not only extract the minor element, but enhance recovery of the major pay metal, because the metal that you're extracting has deleterious effects on the mainstream. So suddenly you start to see opportunities and options, and I think this is the time to do it.
Neville, thank you very much, Sean.
Thanks very much, everyone. I think that's all we got time. I had a couple of questions, but I'll obviously pass those on. I'd like to give a big thank you to Dr. Nomvar, Rick and Neville and the team for sharing their expertise today. I thought it was really an amazing presentation. And like I said, I have many questions, and I'm sure the audience does. So a recording of this webinar will be available for on-demand viewing, as well as being available on Osmine's YouTube page. If you have any further questions from today, please contact us and we'll put you in touch directly with Mobin, Neville or Rick. And thank you for everyone who attended the webinar today, and we look forward to welcoming you to the next Osmine webinar event or other events, and enjoy the rest of your day. Copper of the World's coming up. Put that on your calendar if you're into the copper space. And for those Victorian and Tasmanian members, make sure you sign up to our LinkedIn group, and we'll see you at the next CEO lunch next week. Okay, thanks very much all. Really appreciate it.
Thank you.
Thank you.
Thanks everyone. Cheers.
Thanks a lot.